Good morning, everyone. Today we are going to talk about Lennar Corporation. So let's dive in why Lennar Corporation is a great investment opportunity. So Lennar has been around since 1954, and the company is headquartered in Florida. And Lennar is the second largest U.S. home builders. And if we talk about the company's revenue, the company has made around 35.4 billion in revenue just in 2024. And let's deep dive and talk about the company's business model. So the company uses a land light approach business modeling, meaning they optional contract, which means they pay a small amount in order to reserve the land, but later on they decide if they want to keep the land or not. And this is also one of the reasons why Lennar have a 2.4 billion in cash. This helps them have more control and also keep more cash for other activities. And Lennar started this approach since 2020. So let's move to the company's free cash flow. The company's free cash flow moved from a negative 811 in 2014 to 2.2 billion in 2024. However, it peaked in the year 2023 at a 5.8 billion. And as I mentioned earlier, the company has a 2.4 in cash, which the company uses for reinvestments, share buybacks, and other spending activities in 2024. If we talk about the debt management, the company's debt moved from a 5.2 billion in 2014 to 2.2 in 2024, which means the company has a strong control over its debts. As I mentioned earlier, the company has a 4.9 billion in cash, which is more than double its debt. And if we look at the cash to debt ratio, which is 117% in 2024, means the company has enough cash to cover its debts. If we talk about debt to equity ratio, which is 0.15, it shows a financial stability. Let's move to the interest rates and backlog. High interest rates, high mortgage rates costs lower the home buyers demand, and the rate rose in 2024, which reduced the demand for homes. So the backlog value dropped from 6.6 billion in 2023 to 5.4 in 2024. It is because of two reasons. One of them is less orders and less homes under contract. If we talk about the shareholders, Lennar enjoys giving to its investors through two things: buybacks and growing dividends. The company has bought back its shares for around 1 billion in 2024, which boosted the earning per share. Earning per share grew from $13.98 in 2023 to 14.31 in 2024. Lennar has a really healthy cash flow and a very low debt, which makes the company stand out. If we talk about the company's intrinsic value and risks, based on my evaluation, the company could be worth of $206, which is more than its current market price, which is 112 per share, giving you around 84.5 upside. Of course, there are many risks like high interest rate competitions from companies like D.R. Hortons and Toll Brothers, and also raising material costs due to tariffs. And although the trade tensions and high consumer confidence, but the job market is still strong. Also, the current Trump administration is putting pressure on the Fed to cut out the rates. Any questions?
Okay, so I think it looks like a promising company.
Yes.
Now you're saying there is around 80% plus upside potential.
Yes, based on my
So,
valuation.
so where does Lennar stand compared to its competitors like DR Hortons, Toll Brothers? What is its market share?
The company's market share is for around 15%
Okay.
after the DR Hortons. And
Okay.
if we talk about the return on equity, it is around 18%, which is around 18%. And for the other competitors like DR Hortons, it is 16%. And if talking about Pulte, it's 14. So Lennar has more compared to its competitors.
Okay, so it has a higher market share compared to Toll Brothers, I guess.
Yes.
And
And
what
Pulte.
is it? What's the ROIC?
ROIC is 12%.
And what is the ROIC of other companies like?
For DR Hortons, it is 10%, and for the Pulte, it is 9%. So the Lennar has more than its competitors.
Can you go back to the previous slide where you mentioned the backlog, right?
Yeah.
So can you tell me the value of backlog?
The backlog.
Because that's gonna tell us whether it's gonna reach the intrinsic value in the next few years or not. Yeah, here. So you mentioned the backlog, right?
Yeah.
So what is the exact value of the backlog?
It is for 2024. It is of
Okay, it's there.
5.4 billion, and the number of homes is around 11,633.
This is as of 2024 or 2023?
2024. As of 2023, it is 6.6 billion, which slightly fell to 5.4 billion in 2024.
So it fell from 11,633 homes, right?
No, it fell from 14,892
Okay,
to
892.
11,600.
And the average price per home is 462,000, right?
Yes.
Which has actually slightly gone up as compared to 2023. Okay, and then it also has some cancellation rate of 14%.
Yeah.
Okay, can you go to the debt level? You also mentioned the cash to debt, right?
Here.
So the debt level has actually been reduced. It's reduced from 5.2 billion
to 2.2.
2.26 billion. So it has excess cash. So the cash to debt is 117%, which is good.
Yeah.
So it has more cash than the debt. And the debt to equity ratio is 15%. Do you have any idea what's the debt to equity ratio of other competitors? The competition analysis.
No,
so I'm pretty sure it's gonna be higher because we did an evaluation of Toll Brothers. I think for sure it's going to be higher for the competitors.
This company has the lowest debt levels compared to its competitors.
Yeah, so it's going to be higher for the other competitors. Yeah. That's for sure.
Yes.
Okay, so I mean, when I look at the surplus cash, so the free cash flow is free cash flow to revenue is 6.3%, which is not bad. So, and then I think this company is growing at what rate? You said, is it 20%? The revenue is growing at what, 17-18%, right?
Yes.
Okay, so
17 to 18%.
Okay, which is not bad. So this looks very promising among all the companies that we have evaluated so far, whether it's Toll Brothers, Pulte Group, or even DR Hortons, which it has the highest market share. So I think this particular company seems to be the best among all, if I'm not mistaken, because I think having a lower debt is what
that's what makes this company stand out.
Yeah, it gives us a huge, and then it also has a huge margin of safety, and I think it makes it more compelling as compared to others.
It has a 4.2 billion cash.
Yeah, which is not bad at all. Okay, so this sounds good. Farid, do you have any questions?
Yeah. So, what is the Lennar's debt profile and interest rate risk?
As we discussed now, the company has a very low debt compared to its competitors, and the company has enough cash to cover its debt levels. So that's it's
Yes.
yeah.
So, do you think why is now a good time to buy Lennar shares considering the current macroeconomic environment?
Yeah, according to me, right now during the Trump administration era, it is really amazing to buy these shares because he's putting pressure on the Fed to cut down the rates. So during his administration, it's a good thing to buy his shares. Also, based on my valuation, it will go around up to 206 per share, which is 84.5% upside.
That sounds good.
So, I mean, one of the challenges that I see is the higher interest rates because they are also into lending. So they do offer mortgage services. So I think the Fed has already said that they're going to be cutting the interest rates. There's going to be two cuts, if I'm not mistaken, this year itself.
Yeah.
Now, obviously, Trump has been in real estate business. That's his main core business, right? So he's going to be putting a lot of pressure to make sure that happens. I think if the interest rates go down, which is now, in fact, uh, you know, I would say it's more certain than than previously thought. So then I think that's going to give a boost to the real estate industry, and also on the tariffs, right? Because imposing 30% plus on China, and then you also have tariffs at least 10% on Japan, which is the standard, right? By the Trump administration. So if the tariffs are reduced, because it puts a lot of pressure on costs,
Yes.
on building material, on steel. So I think that will also ease the pressure on the premium real estate segment, right? That Lennar is in. So you know, I hope all this is actually eased, so that it will all be advantageous for Lennar and all the other companies that we have discussed in this segment. So I think there are a lot of positives. This particular company, when I look at it, has lost more than, I think, 30% of its value the last couple of years.
Yes.
It did go up for a while since 2020, and then it lost trajectory. That is because the Fed started raising rates. So now I think it's getting back to normal, the way I see it, this particular industry, right? So and then, as I said, right, the Trump and everyone in his administration, I think, are advocates of real estate, right? Are in real estate business, I would say.
Yes.
So that's gonna be a big plus. That's gonna serve as the catalyst for this particular
For
industry.
investing in this company.
Yeah. So okay, so this sounds great. It looks great. So I think this seems to be an excellent investment idea. So is there anything else you want to add?
No, thanks.
Okay, so great stuff. Maha, thank you very much.
Thank you.
This seems to be an excellent idea, I would say. And I think you have put in a lot of work, so the presentation was great. I think we have covered a lot of stuff here. So, is there anything else that you think is important?
Yeah, also I would like to address why the FCF dropped in
Okay.
from 2023 to 2024. It is because of the company has bought back its shares for around 1 billion in
Okay.
2024. Also, the company has paid its debts, and also there were less new orders, and also due to higher tax rates.
So the company has been buying back shares. I
Yeah.
think this is also a company
very
that pays
plus,
dividend,
yeah.
right?
Yeah.
So what is the dividend yield? How much does it pay?
It's not mentioned here.
I think it's around 1.5% something,
Yeah.
if I'm not
Yes.
mistaken. So, that's another positive. So the company has been buying back a lot of shares. That is
Yeah.
because it's been generating a lot of free cash flow. So,
To boost the earning per share.
yeah, so in the next, I think, few years, when we look at the backlog, that in itself is like 5 to 6 billion. So I think in the next, I would say 5 to 6 or maybe 5 to 8 years, I think its revenues could easily go up to 50 billion plus, the way I see it. So yeah, so this seems to be a good company compared to a lot of others that we have covered, that we have evaluated, right? So yeah. Okay, so great stuff. So I think we can end it here.
Yeah.
And yeah, okay, so this is great. Thank you very much.
Thank you.
Thank you.